A lot of beginners think trading is a single action, just logging in and clicking buy or sell. But the reality is quite different. Professional trading is a continuous process that starts long before the market opens and ends well after it closes. By the end of this video, you will have a strict, step-by-step daily operating procedure designed to help you execute trades based on preset logic rather than sudden impulse. To follow along and build your own system today, you only need two things: a blank spreadsheet or notebook and your charting platform. Building a rigid daily routine acts as a practical barrier. It creates boundaries that protect your capital from the common cycles of panic, greed, and the fear of missing out. So let's start building your day right now. Step 1 begins when you wake up. We follow a strict no charts before 8 a.m. rule. Looking directly at the market from bed risks exposing you to sudden red candles or overnight crashes. That immediately influences your mood, which can skew your decisions for the rest of the day. Instead, around 8 a.m., we perform a market weather check. This step is about reading the global sentiment to understand the current economic climate. Looking at a dashboard like this gives us the 3 macro elements we need to check daily. First, we look at whether the US and Asian markets closed green or red. Second, we check the dollar index and the gift Nifty. And third, we scan for major scheduled news events, like policy announcements or company results. But remember, news is not a direction to trade. It is simply fuel. A positive earnings report might cause a surge, but you never trade the headline without seeing price confirmation on the chart first. Completing this macro check gives you the market's inherent bias. You know the weather conditions before you even look at an individual stock. Now we move from the macro to the micro. There are thousands of available stocks on the market. Trying to track all of them leads to confusion. Instead, we filter that list down to a highly focused watch list of just 5 to 10 tickers. We select these specific stocks based on strict criteria: high trading volume, clear price trends, or significant gap up and gap down momentum. Once you have your targeted list, you build your pre-market plan. The math for every potential trade must be written down and finalized before the opening bell rings at 9:15 a.m. For every selected stock, you log 4 mandatory data points: your exact entry trigger, your stop-loss level, your profit target, and your absolute maximum risk limit for the trade. Keeping this list to a maximum of 10 tickers keeps your attention sharp and prevents the paralysis that comes from having too many options. Locking in the math before the market opens detaches your decision-making from the live price action. When the numbers are already decided, you don't have to think during a trade. You just execute the plan. At 9:15 a.m., the market opens. This is the most volatile period of the trading day. Institutional orders are filling, and prices often whip back and forth without a clear direction. Because of this volatility, we follow the unbreakable 15-minute rule. You take absolutely no trading action until 9:30 a.m. You let the initial chaos settle. During those 15 minutes, your job is purely observational. You watch the volume patterns, gauge the strength of specific sectors, and wait for the market to reveal its direction. Once a setup appears that matches your criteria, you apply the survival rule. You execute the trade exactly as dictated by the pre-market plan you wrote down earlier. No improvising. Most importantly, you protect your account by honoring the hard stop loss. A small planned loss is a normal part of the business. Removing your stop loss out of hope turns a routine exit into a massive, account-draining event. Capital preservation is the priority. Survival in the market is more important than trying to capture every single move. When the market closes at 3:30 p.m., the day isn't over. A trader's long-term growth happens in the hours after the bell. This spreadsheet template is your primary resource for continuous improvement. The post-market trading journal provides a clear record that helps separate professional habits from amateur mistakes. For every trade you took that day, you log the technical data. You record a screenshot of your entry, a screenshot of your exit, and the logical reason you took the setup. But the most important part of this journal is the emotions column. You must honestly log what you felt during the execution, whether it was FOMO, fear, or greed. Tracking your emotional state right next to your entry and exit data exposes patterns. You will see the specific psychological triggers that lead to your recurring mistakes. This checklist summarizes the 5-step process we just built: the 8 a.m. macro prep, the tight 5-stock watch list, the rigid pre-market plan, the execution rules, and the post-market journal. Trading is a long-term marathon. You won't find a perfect setup every single day, but a disciplined routine provides the necessary framework for your strategy and risk management to perform consistently. Take this checklist, print it out, or pin it to your desktop so it is the very first thing you see tomorrow morning. If you built your routine with us today, hit the like button and let us know your maximum daily risk limit in the comments below.